Here's my comprehensive list of stocks to buy in 2024 and the reasons I'm investing in each. Number 1, Adobe. Among the list of stocks that I watch and evaluate, Adobe stands out significantly as an undervalued stock for multiple reasons. While I typically focus on high growth stocks if you're invested in this channel that usually don't pay any dividends, Adobe is a dividend growth stock that has a tremendous potential for upside, especially given the pullback. Just look at the chart. I can't ignore Adobe's potential with its strong recurring revenue and its brand. Since AI started dominating discussions in 2022, many investors have overlooked Adobe. However, I believe this has created an excellent opportunity for savvy investors like us. Let me explain why I'm bullish on Adobe. First of all, Adobe is benefiting from strengthening in generative AI capabilities. The solid momentum of its family of creative generative AI models, Firefly, is a major positive. In order to deliver enhanced experiences to various enterprises and customers, the company is constantly making efforts to bolster its generative AI-backed offerings. Given I have Palantir and Nvidia on this list, you can tell I am bullish on AI in general. The stock started the year at $580 per share and now is down more than $100 since the start of the year. I bought most of my shares in Adobe in early 2022. At the time, I admired its robust revenue growth, pricing power, and the stickiness of its cloud-based subscriptions. However, I sold many of my shares as the stock rose higher and higher as I saw its growth was cooling off and management didn't seem to have a clear plan for the future. Planning is very important. Given no plan, I couldn't justify Adobe price to earnings valuation. But now I see more potential in Adobe and I've started to buy shares, especially as it's pulling back and because I use the services myself and I see many other businesses are going to Adobe. The top line revenue is super consistent and continues to grow. Now, second stock is Nvidia. Given its 10-to-1 split, I think this stock will see a rise in demand. Nvidia has been a big beneficiary since it designs the chips used to train many large language models, the foundation of generative AI. I personally like to prioritize companies with competitive advantages. It's also important to invest in growth companies that possess a strong competitive advantage. Otherwise, their competitors may pass them and their growth may not last forever. Nvidia, although one of the biggest in market cap, is a decent investment for the long term and will still outperform the market, in my opinion, in the next coming years. My degrees are in finance, data analytics, and I studied competitive advantages in great detail because Warren Buffett, amongst other influential figures, have taught me to pay attention to how companies compete in a market. Looking at competitors is one of the most important things when a company is looking to gain market share. A competitive advantage becomes especially important during turbulent times when there's a lot of volatility, such as during a pandemic or periods of just regular or high inflation. A strong competitive advantage will help companies survive and thrive through market downturns, while those without a competitive advantage will struggle in many ways. As a simple example, talented employees simply just leave a company when it can't offer the best compensation and career advancement. You know for yourself, you probably jumped ship from a company if they weren't paying enough or one of their competitors were just paying a better salary. I also mentioned the stock split being a big catalyst for me. Stock splits reduce the price per share without affecting the company's overall market cap. For many individual investors, a lower price per share makes the stock more affordable, potentially increasing demand as more investors can now buy shares. A stock split increases the number of shares outstanding, which can enhance liquidity. With more shares available for trading, it becomes easier for investors to buy and sell the stock, often resulting in tighter bid-ask spreads, which is actually phenomenal for option trading as well. A company typically performs a stock split when its share prices have just risen significantly and become very expensive for the general market or for someone to buy one share of. So if a stock's over $600, $700, that's typically when a stock or the company or the management starts to think about making a stock split. We've already seen that with Chipotle as well. This often reflects strong historical performance and growth, which is a really good thing. Investors might perceive the split as a positive signal that the company is confident in its future prospects. Investors may have psychological preferences for stocks with lower nominal prices, which is also not really a problem. It's pretty good actually when other investors think something is cheaper but it's not, but the stock goes up. So you can take advantage of this. A lower price can attract a broader base of investors, including retail investors who might feel more comfortable buying shares at $100 rather than $1,000. Historically, many stocks experience an increase in demand post-split. Now, one more time, stocks typically go up after a split, which can drive the price up in the short term over the next 1, 2, or 3 months. While past performance is not indicative of future results, this trend can make post-split purchases very attractive. A stock split does not change the intrinsic value of the company in any way, as I mentioned on this channel before. It's basically like cutting a pie in multiple pieces. The pie is still the same, or the calories of the pie is still the same. The fundamental analysis remains the same, and the split merely alters the share price amount and the share price cost per share. This makes it an opportune moment to buy into the company's prospects without changing the underlying fundamentals. And for me, having Nvidia go down so much actually is a really good purchase. So I ended up buying it yesterday in my Discord community, and taking me some time to edit this video, but still, it is not too late to buy Nvidia. So Nvidia keeps beating and raising in the past 3 quarters. So I think that is going to continue. And the biggest midterm catalyst for Nvidia is that demand is sustainable past 2025, which would blow the current 18.86 growth estimate out of the water. If we are still early in the generative AI journey, it's likely to happen based on the facts that even OpenAI wanted to make their own chips, and some other facts we can speculate the demand will be stronger for longer. The risk lies in the potential for demand to be pulled forward, where major customers might start cutting back on orders once their chips are operational. However, in my opinion, creating the best chips requires significant research and development costs and frequent refresh cycles. With Nvidia's extensive experience, it is likely to continue outperforming custom chips to the extent that producing custom chips becomes really impractical. I think Nvidia is easily a 10% stake in anyone's portfolio. We talked about competitive advantages. Now I'm going to teach you something new with stock number 3. Stock number 3 is going to be Meta, or formerly Facebook. And Facebook has one of the best network effects. So a network effect is something that I also learned back in college before I worked for Goldman Sachs. And each person who joins a network effect, or each person that joins a social media platform that is Facebook, is going to increase the value of Facebook. So a network effect can make it difficult for new entrants to basically come into the market, because if everyone is talking about Facebook, the more people that go on Facebook, that means more people want to go on Facebook. Same thing with Uber. If you look at Uber, the more people start driving for Uber means that there's going to be more cars available for you to hire. So it's going to make it faster for you to hire a car. And the more cars people are trying to hire, the more Uber drivers come onto the platform, because there's money to be made and there's customers looking to get an Uber. So basically, that is what a network effect is. And Meta's 3 billion users across its family of apps certainly make it very unlikely that a new social media can come up and just kind of like displace Meta. That's going to be very, very hard. And then also, talking about artificial intelligence, AI is all the rage on Wall Street, and Meta plays into multiple of my theses. So today, deep-pocketed technology companies are investing billions of dollars to accumulate the broad computing power needed to develop, train, and use AI models. Well, Meta is one of the companies leading the pack. Mark Zuckerberg disclosed earlier this year that Meta aims to accumulate 350,000 of Nvidia's flagship H100 graphic processing chips by year-end, giving the company a total computing capacity of roughly 600,000 H100 equivalents when factoring in Meta's total chip hoard. So basically, that's why I have both of these stocks on the list, because Meta is buying all of Nvidia's chips, Nvidia is making lots of money, and Meta is just looking really good for an AI play. And I think the market notices this, and that's why both stocks have done so well in 2024, and I think it's going to continue to go well into 2025. The H100 chip is easily optimized for AI workloads, and these chips cost over $40,000 each, giving you an idea of Meta's astronomical investment in AI. Management has guided for capital expenditures in 2024 to fall between $35 and $40 billion. So Zuckerberg noted that AI will become prevalent in Meta's business. Already, the company has developed and integrated its large language model, Llama 3, into its social media apps and deployed AI tools to help advertisers optimize their marketing dollars. AI will continue, guys. I think AI will continue appearing in Meta's augmented reality business, including the Quest headset line and the Ray-Ban Meta smart glasses. AI is all over the market, and a stock like this I think is going to do very, very well. I think the stock is also cheap on a long-term basis. Calling Meta cheap kind of feels off, considering shares have climbed over 80%, as well as Nvidia is just very, very expensive in its historical chart. But look, I think if you pay attention to the numbers, they do reveal that the stock has a very inexpensive valuation at the moment given future prospects. Analysts believe Meta will earn about $20.15 or $20.20 per share this year, which values the stock at a forward price to earnings ratio of about 24. They also believe Meta will grow its earnings over 19% annually for the next 3 to 5 years. Now, remember, Meta's Reality Labs segment is currently dragging on profits because it's losing money. Eventually, that segment could come alive, and that will really improve the stock's performance as well and its valuation. I also use the PEG ratio to evaluate how attractive a stock's valuation is relative to the company's expected growth. This is something that I teach in my bootcamp. And by the way, if you do want to join my bootcamp, I finally have one. It's been 6 months since I've had one. You can learn more about it by clicking the first link in my description. It is going to be starting later this month. Now, the PEG ratio is currently 1.3, a good deal if the business can meet growth estimates. Now, the next stock is going to be Palantir. In the past month, Palantir has risen by about 8%, making it a very profitable stock to hold. I've made so many videos on Palantir because it is a very good stock to trade options on. And personally, I really like the innovation and that they just keep winning contracts. So the strong innovation, for example, they had an event, AIPCon, and Palantir CEO Alex Karp showcased how the company applies lessons from wartime to driving business growth, and their cutting edge technology just continues to become more rapid in its advancement. I really like the CEO. He went to my high school, and not just that, I just like the business overall. Their solid contracts are there to stay. I mean, if you look at how they keep winning business, they recently had a 5-year, $480 million agreement with the U.S. Department of Defense for Project Maven, which aims to enhance battlefield intelligence. So because Palantir has their hands in the government's pockets, I really like that because the government is going to keep spending our tax dollars, and taxes are probably not going to go down anytime soon. Bullish long-term outlook. If you look at Palantir's business, I think the stable growth that they have is a very good sign that the company and the stock is going to continue to do well and is a very solid long-term investment. Now, I mentioned government partnerships. Ongoing partnerships with the U.S. government and other entities provide a strong foundation for future growth and revenue stability. So making money with Palantir is actually pretty easy, even if you just buy and hold the stock, or even better if you're doing, covered calls or selling puts or the other strategies like the wheel, which, by the way, I recently made a video. You should be checking out my videos because you will make more money if you're trading options on high quality companies. So holding Palantir can yield substantial results as the company continues to innovate and secure new contracts. And their consistency in performance is just phenomenal. And I recently talked in my last video how a 57-year-old retired student of mine named Sanjay invested $600,000 in his portfolio, a lot of that being Palantir, and he's had really consistent, reliable results by just running the wheel on Palantir. So that's why Palantir is one of the top stocks in 2024. Now let's get to the next stock, which is going to be Google. And we are actually on Google right now as you're watching this YouTube video. That is part of Google. Google, we can simply just look at the facts. Estimates are calling for earnings of $7.69 per share and revenue of $291 billion. These results would represent year-over-year growth of over 30% and 13% respectively. Just looking at the valuation of Alphabet, it is presently trading at a forward PE ratio of just over 22. The valuation is less than the S&P 500, but the growth is more. So if you let that sink in, the valuation is less than the S&P 500, yet it's growing faster. This is an absolute no-brainer stock. Now, there is actually several billionaire hedge fund managers who actually ended up trimming their position in stocks like Nvidia and deploying the capital into a stock like Google and Alphabet. So Steven Schoenfeld of Schoenfeld Strategic Advisors sold 96,793 shares of Nvidia, reducing his stake by 58%. Meanwhile, he increased his stake in Alphabet by 195%, making it the 9th largest portfolio position excluding option contracts. So I think that Google is one of the strongest stocks that you can invest in because of search volume continuing to go up, and YouTube itself is really just dominating. Next stock is going to be Apple. If you watch my videos, you know that I have over $1 million in Apple. I currently have about 5,000 shares, and this stock is just literally my favorite. And that's because not only does Warren Buffett have it, and a lot of hedge funds have this stock. It's one of the biggest in market cap, right? Top 3. I believe it's number 2 right now, depending on where Nvidia is. Just looking at the brand strength, okay? For me, the product ecosystem that Apple has and the integrated product ecosystem, including iPhones, iPads, MacBooks, and services like App Store and Apple Music, they ensure customer loyalty and recurring revenue. Believe me, Apple is having a lot of recurring revenue, and that is what makes this stock so safe. That's why I tell my students they can have as much as they want in Apple. It's basically the S&P 500 in a way. So if you look at the innovation reputation, it is known for its innovation and high quality products. Apple has a strong brand that commands premium pricing and customer trust. Now, the craziest thing is, and even if you look at some YouTubers, people just price things based on reputation and brand. I've seen so many basically trading YouTubers charge like $10,000 or $20,000 for their trading program when they literally don't even have an education or experience on Wall Street, just because they have a big brand. And that's basically the same thing that all these big companies do. It's unfortunately a marketing game, and it's not always a product game. It's not always how good your product is or how much you teach or how good the phone is. Sometimes it's just literally the brand, and Apple has brand, that is for sure. And also financial health. Looking at their robust balance sheet, they have substantial cash reserves, they have strong earnings, and Apple has the financial flexibility to do anything that they want. It doesn't matter what the economic downturn is. They have so much cash, they can withstand a very long time of even poor results, which is not really going to happen. It's not likely to happen anyways, but they can definitely withstand a tough time. And looking at the future, I think they have an AI strategy as well in their product development. The market is eagerly awaiting Apple's AI strategy, which could drive significant growth, anticipating product announcements and just other AI things. They are definitely working on it. And then also looking at the market sentiment, recent stock rallies reflect positive market sentiment, and investors are very confident in Apple's future. We can see that because the stock swung up tens of percent, and I've been holding thousands of shares. So it's been really beneficial in 2024. And I think that stock's going to continue doing well in 2025. If you want to learn more about top stocks, or if you just want to be part of my bootcamp and get hands-on coaching, make sure to check out that first link in the description. And please subscribe to the channel. It would mean a lot to me, and it's also going to help you out. So catch you guys in the next video.